Okay, here's the final section of our lesson today on crashes and crises, and we're going to take a closer look at the Wall Street crash, the famous Wall Street crash that everyone's heard about in New York in 1929. We've got here the front page of the newspaper Brooklyn Daily Eagle from October the 5th, Thursday, Black Thursday. Wall Street in panic as stocks crash. We're going to take a look and see what happened. So we had the Roaring '20s. Everything was looking good, having a good time. We had also we had the Prohibition as well, which is why if you go to the States you can still go into the speakeasies and cocktails and dancing and have a good time. And we went from there to collapse in the 1930s. So here we can see people were short of liquidity, banks weren't lending, banks were in trouble. So here's this chap with his car, $100 will buy this car, must have cash, lost all on the stock market. People, once again, getting psychologically tied into jumping on the bandwagon of making easy money on the stock market. Prices were going up and up and up. It's very difficult when you hear that your friends are making a fortune or not even working. Think, okay, I'm going to borrow money and get in on this deal myself. So here's the countdown. Monday 21st of October, the ticker falls 1 hour 40 minutes behind. Now the ticker was the ticker tape was giving the prices, the changes of prices of the different shares. And of course, if you're in the marketplace, if you're there, you're all waving your arms around and trading and buying and selling. You need to know what the price is now. So if there's so much volume going on that the ticker is 1 hour 40 minutes late, it means you don't know anymore what has happened during that time to the value of the shares that interest you, whether to sell or buy. So that created a certain amount of panic. Thursday 24th of October, called Black Thursday, panic sets in as some sales find no buyers. These are called air holes. It's like when you're in an aeroplane, you hit an air pocket or an air hole and suddenly the plane goes down very abruptly. It's quite frightening. Well, an air hole in the financial markets means there's simply no one at any price is going to buy the shares. 11 well-known speculators commit suicide. It's a bit exaggerated. There were talks of hundreds of people jumping off buildings and committing suicide. It did happen, but overall in the States the suicide statistics were fairly normal. 12:30, the visitors gallery of the stock exchange is closed in Wall Street. Normally there's a gallery where you can see the trading that's going on with a very special sign language that they use to instruct the buyers and sellers. So they close the gallery because it's too much panic on the trading floor. And the richest bankers, they're the ones who are also losing a lot of money. They decide to get together and start buying. So the idea is to recreate optimism in the market. Trading and speculation depends very much about emotions and about whether people are feeling pessimistic or optimistic. So they pool their resources and they start buying. So they're walking around the stock market saying, I'll buy this, I'll buy that, and other people see the big bankers buying. They think, okay, they must know something we don't know, so maybe we should start buying as well. That was the idea. Stocks recover as spare cash finds bargain sales for shares. The ticker becomes 2 hours late, but you've got the center hub in New York where they know what's going on and they're interested in the bankers' efforts to try and save the system. But out in the countryside, they're way behind, and basically they're panicking as their savings have been tied up maybe in shares, and the general flow of selling shares is not going to stop. So the bankers, Monday the 28th, slide to the bottom. The bankers have lost their money. They couldn't get enough people on board to create a feeling of optimism that they'd hit bottom. They hadn't hit bottom. And there's no bankers rescue. Tuesday the 29th of October, the most devastating day in the history, Black Tuesday, air holes everywhere, the whole system collapses. And a messenger boy buys a block of white sewing machine shares for $1 a share. They were previously at $48 a share. So if you've got money, then there are some amazing bargains around, but the banks won't lend anybody any money. The banks have overlent, so they're not lending anymore. A lot of them are going to go bankrupt themselves. And people, because they couldn't sell their shares to have the liquidity, there's not enough liquidity around to buy these really good bargains. The bankers start selling as well, and the credit based on shares dries up. People used their portfolio of shares. You can use it now. If you want to buy a house, you can go to the bank and you can say, here is my portfolio of shares which is worth so much. And you use that as risk, as capital against the risk of the bank lending you money. But what happens if your portfolio suddenly dries up and is worth nothing? Then what was the basis of borrowing money has suddenly dried up. So credit dries up. When banks are in difficulty, when banks don't have enough liquidity, they use the interbank lending system. So that there's normally always liquidity available. But if banks start going bankrupt, then suddenly the interbank lending system breaks down because it's too much of a risk. You don't know if the bank you're lending to is going to fail or not. So suddenly banks are on their own, too much lending, not enough capital, they're in trouble. So Clark's in downtown hotels ask clients if they want the room for sleeping or for jumping, and you can see someone here who's jumped off the top of the building and ended up as a pancake in the street with a little crowd having a look. Certainly some people, they lost everything in this crash. Now, as I mentioned previously, there's a difference in terms of the value of what you have and the share value. We can see here some of the falls from some of them quite short times. So we can see Times Industrials falling from $224 to $28. US Steel from $262 to $22. Now that's crazy, because US Steel has got foundries, it's got enormous infrastructure. If you end up with a value well below the value of the infrastructure, then normally that should attract buyers. This is often when what we call vulture funds move in. A vulture fund moves in not to save a company, but to actually sell off its assets. It will come in, buy up the company, and lay everyone off and sell off the assets. General Motors, same thing, $73 down to $8. Sales are obviously, there are no sales anymore, no one's got money to buy cars, but the infrastructure is still there, the factories are still there, the machines are still there. Retail, not Montgomery Ward Retail Companies dropped $138 to $4, but they've got shops, they've got buildings, so the price, the final share value is well below the actual infrastructure value of the company. Investment trust, an investment trust hasn't got enough real assets, so it's not surprising they fall from $117 in September 1929 to 70 cents in July 1930. Now the trouble is, each time we have a crisis, whether it's the subprimes crisis, whether it's the Greek debt crisis, whether it's the 29 Wall Street crash, is the social effects. So here we have this famous photo in a Hooverville. Now Hoovervilles were these people moving off the farmlands into these ghettos around the cities, which were called Hoovervilles because Hoover was the president and he was seen as being responsible for all these people moving into the cities, as 13 million people were unemployed. In these days, there is no unemployment benefit, there is no social security, there's nothing, there is no safety net. The resources to save people basically were coming from the churches and from associations. This was also the beginning of the Great Depression. It wasn't just a financial disaster. USA was also going through an environmental disaster. If you read the book The Grapes of Wrath, then by Steinbeck, that talks about these farmers, the cotton growers, leaving the land due to the Dust Bowl. They'd removed the trees, they'd removed the hedges, the soil was being swept away, they'd damaged the whole microclimate, if you like. So thousands of farmers leaving the land, moving to the cities, trying to find jobs when there are no jobs available. Now this is a slide I really like. I'll just make it a bit. You can see it on your computer as well. The Great Depression of the 1930s. Here we have the most powerful, the richest country in the world with this fantastic advert. You've got Dad, Mum, the two kids all smiling in their car because they were able to buy a car. Great time for the middle classes in the 1920s. And it's written, "There's no way like the American way." This is it. This is the country of wealth, of opportunity. No way like the American way. And here you've got this queue of people, mostly black. Obviously the Hispanics and the blacks had a harder time. And they're queuing up to go to a food bank or a soup kitchen to be able to eat. Here we can see let's make it a bit bigger, the unemployment rate from basically zero unemployment in August 1929 all the way up to over 25% by August 1932. Then this is when Roosevelt is elected, and this is when his Keynesian economics start working. We can see this little dip here. This is when he's being told that the money he's pumping into the system, he's pumping too much money in, and now he should change policy. And he changes policy much to Keynes's disgust, and suddenly employment starts going up again. And Roosevelt's not got a clear direction from the beginning. He's working it week by week, if you like, and seeing what works and what doesn't work. Same thing here. He thinks they're out of the problem. It's all about how much money the government's putting into the creating employment, and a reversal here, and then we end up with war. Nothing better than a war to resolve the crisis. Now, some people will say that Keynesian economics didn't work to solve the Great Depression. This was the New Deal, which is another presentation, and you can see it on my website, the New Deal. We won't have time for it in this lesson. But the New Deal was about providing security and jobs for the people, and providing minimum wages, providing social security, providing unemployment benefit, providing labour unions and the rights of unions to negotiate their salaries. A massive transformation in the American way of life. And if you want to really resolve employment, join a war. 1942, zero unemployment as the war kicks in. So some people say Keynesian economics wasn't what saved the USA from the Great Depression. It was the war. Keynes would say Roosevelt did the right things. He wrote to Roosevelt, he said, but you didn't do enough, you should have done more. And this is interesting because what have we done after the 2008 subprime crisis? We had a choice between the Green New Deal promoted by many people in the European Parliament and ignored, and we did the Hoover austerity plan promoted by the Germans, exactly the wrong thing to do. All the economists said so. Austerity doesn't work, it makes things worse. And maybe we haven't learned the lessons from the Wall Street crash. So here we can see people. Let me just check the computer. Okay, we'll continue later on because I ran out of battery.